Welcome, welcome, welcome. Ladies and gentlemen, degenerates, we got a great session for you today. By the way, I'm Rodrigo. I'm going to be here with Matt Maley, Chief Market Strategist at Miller Tabak. You've probably already seen him on CNBC, Bloomberg, and all these European, Asian channels, whatever. He's all out there. But he does have a live trading room, and we're going to show you a little bit about how he's been making some good profits, right, throughout the year. By the way, also, it is Matt Maley's, I think it's tomorrow, but it's his 40, I don't even have enough fingers to count it, but it's his 40th year anniversary of working in Wall Street. So show some love today, respect for Matt, for all he does, for the retail traders, for the community, people like you and me, the little guy. So what's up, Frank? So yeah, we're gonna be with Matt today. I'm waiting just for him to get the link. Harvey, if you're watching, make sure that Matt has the link. A couple shout outs to the folks here. Albert, what's going on, dude? Mr. Anthony, Bill's in the house. David, what up? Milky Fade, Guy, John, like 20 Johns, Nick, XP, Yuan, Yao, what's up, dude? So, by the way, folks, we do have an international community, okay? Heads up. We do have people that are in the chat room from all over the world. We got John Moore in the house. What's up? And Grandma Stocks. Well, Granny Watch Stocks. What's up, Granny? Good to see you here. So, Michael, we're going to go over that later, but we got a lot to cover. I'm glad you're here because you don't want to miss this session. We're going to cover crypto, trade ideas, options, education, market discussions, micro, macro. You guys are lucky that we do this, honestly. Like, it's a blessing. I wish somebody would help me out as much as I help you guys out. Johnny is in the house. What's up? Mr. Miller, Grandma Stocks. Look, anybody can trade this, right? Crypto 1929. What does that mean, David? Are you bullish crypto? I'm not bullish crypto. My cat's also in the house. Big shout out to the cat. Michael, John Marker, Johnny Magic. What's up, Johnny? Magic Marker. All right, folks. So, all right. Yeah. So we will be going about trade. We will be talking about trade ideas, options, education, market discussions. Again, this is from an agnostic point of view, because ultimately our success is your success. If you're a successful trader, that means we did our job right, especially Matt, because he puts out so much out there for you guys. And we did throw out some special meetings out. You're going to see everything later when we're going to talk about it. But it's a good session. What's going on, Manuel? John Lee, all the Johns, welcome. Yuan says he needs option trade ideas. Do you need option trade ideas, Yuan? I think you need trade ideas. I think you need education. I think you need a community. I think you need a gang of people helping you out, right? Mr. Rogers, what's going on, dude? We're just setting up here, literally. Yuan, so Yuan, I've talked to literally 9,000 traders since I've been here at Benzinga. I know the ins, I know the outs, I know the mistakes that people make. Personally, I know them myself because I'm a trader as well. So I can literally put myself in your shoes because, again, I'm a trader too. I'm a little guy. I'm not a multi-billionaire hedge fund or nothing like that. We are here for the little guy. Usually the little guy is, everybody's out to get them. But you're lucky that Benzinga's here to save the day, especially with Matt. Because Matt, honestly, it's his 40th. You know what it is to do something for 40 years? A lot of you guys haven't even been alive that long, And he's been in Wall Street. So let me give you a quick breakdown of Matt before he comes in. He's going to come in hot. So he started at Solomon Brothers. It's the biggest trading desk in the 70s and 80s. You might not even know about it, but it basically got bought out. So what's up, Daniel from Iceland? What the hell? Where is that? Antarctica? Just kidding. Before I trade alone is a huge mistake. Yuan, don't ever trade alone, man. I made that mistake. I blew up my account twice. So, again, I've done a lot of the mistakes that you guys have probably done too. But a big game changer was really getting there with Matt. So, I think we do have Matt in the house. Let's go ahead and bring him on. Johnny, what up, dude? All right. So let's go ahead and give a big shout out, a big welcome here to the man himself, the myth, the legend, Matt Maley.
Damn, son, where'd you find this?
Matt, congratulations. I think today is your 40th, or tomorrow, your 40-year anniversary in Wall Street. Is that correct?
Yeah, tomorrow or Tuesday. I can't remember which, but yeah, it's the 29th. 29th. Yeah, that'll be.
Well, look, man, we have a big community here. Lolita says hello from Georgia. Bill, very glad and blessed to be part of this stuff. David, Yuan Yao. All right, folks. So we do have, what's up, Gus? We do have Matt Maley in the house. Again, big shout out, big congratulations for your entire career. It's a great milestone that you've achieved. I highly respect that, man. I know that you're a very passionate guy. So I think that's I think it's great. The fact that, you look at this as something that you actually love and you're passionate about. How does it feel, man, being,
Yeah. Yeah, in some cases I feel old, but it's I've stayed on top of the game over the years, so it's fun. I'm passionate about the markets. I have been for 40 years, and if anything, I'm more passionate than I ever been, especially the way things are going in the marketplace right now. Volatility is great for traders. It's one of the best times to be trading in the market. It's a tough time to be kind of a long-term investor, although you always want to be looking at that stuff. But this is a great time for traders, and I think it's going to continue to be for a while. So I'm really pumped up about what's been going on here and what we're going to do in the future.
Yeah, absolutely, man. I know you have a packed session there, and just for the folks to be aware, Matt Maley is a chief market strategist at Miller Tabak. He is a global equity strategist. He looks at different markets, not just the U.S. markets, and he's going to show you a little bit about that. So, Matt, do you want to go ahead and just share your screen and you can show the folks a little bit of what you've been up to in the chat room? Because even though a lot of you guys might see Matt on CNBC or Bloomberg or any of these other places, he does have a live room where he's basically trading with people like you and me, average folks, taking advantage of the volatility. I would consider Matt as a volatility trading, right? You would call so, right?
Well, yeah, it's fine. There is a specific way, a specific kind of trade where you actually do trade volatility, which is slightly different. But what we try to do is take advantage of volatilities in any market. I mean, and I'll show you here how we've been able to, we tend to focus on options in a big way, although we certainly talk about individual stocks overall, and certainly the macro stuff quite a bit. But it's not just U.S. stocks. We're looking at overseas stocks, any international stocks, international indexes. We're looking at ETFs. We're looking at commodities markets. We're looking at the currency markets. We've made money in all of those markets. Again, overseas markets, emerging markets, high yield bonds, treasury bonds. Again, we have, it's funny because we have these tools that anybody can use now that only the big institutional players could play in the past. But now with these very liquid ETFs, you can trade in so many different markets very easily in a very liquid manner, get in and out of the options rather quickly. And that's what really makes it such a great time to be trading. Again, if you'd done this 10, 15 years ago, it was a lot harder. I mean, if you wanted to do a trade in China, you'd have to call some guy in Hong Kong and hope the broker could do the currency swap for you and all these other things. If you want to do high yield bonds, you had to buy the individual high yield bond. Now you can go in, wheat. I mean, we made some nice money at trading the wheat ETF. In the old days, you had to call the Chicago Board of Trade and find some guy, somebody open an account with a commodities trader in Chicago, which that takes time, et cetera. Now it can be done very, very easily. So we have it's just. And now, again, not only do we have the tools, but the tools trade much more more actively than they used to. I mean, the old days, it wasn't that long ago, where all the options were quarterly options. So if you wanted to make a bet that something was going to happen in the next week or the next 2 weeks, you still had to go out 3 months and pay all that premium, the time premium in your options, and it just took away from the from the profits you could make. And now you have weekly options in all the biggest stocks and in a lot of the medium-sized stocks, 3 times a week in the indexes, and actually they actually do trade 5 times. They trade every day now. The Monday, Wednesday, Friday ones are more active, but the S&P, the NASDAQ, the Russell 2000, those kind of indices, you can trade them for any kind of time horizon. You don't have to pay up several months. So we have the tools, And it's been a great year for us so far. In a year where obviously most people have lost money, in some cases a lot of money. We've been able to profit very, very nicely. And I think this kind of volatility is going to be with us for a long time. And I got to tell you, after a pretty quiet week last week, we saw a nice rally on Tuesday. But other than that, with the holiday, it was very quiet. Next week, and we're going to talk about a lot that today, we got all sorts of individual stocks, indices, currency markets, bond markets, et cetera, that are all at key technical levels and could or should see big moves in the next week or two in one direction or the other. We can, we'll look at those as we go through this
Right.
session.
So, I mean, inflation's bad. Unemployment is worse. What do you think? Do you think unemployment's going to keep? I mean, it's usually the last thing to kind of fall out, but where do you see before we do get into all this stuff, I just wanted to ask you, like, do you think the unemployment numbers are going to keep getting higher? Or do you think we're solid?
It's funny because one of the hardest things for the Federal Reserve, and one of the reasons why they keep the tightening policy, and even though they're almost certainly going to raise rates by a smaller amount, they're still raising rates, is because even though employment is starting to show signs of slowing, especially with all these layoff announcements. They haven't really taken place yet, but all these layoff announcements in the technology sector, but in other areas as well. However, that's not having a negative impact on wage inflation. People are still able to demand higher pay, and these people, and we see now that we could be having a rail strike in the U.S. here coming up. That could be really debilitating for the economy, especially around the holidays. A lot of goods and services or goods not being shipped, but the point is that these guys are asking for more money, and they're going to get it. I mean, they're going to get how much more money is a question. It's not going to be less. And so even if the unemployment picture starts to fade, which is bad for the economy, it's may not be necessarily real good for the inflation picture if wage inflation stays high. We call that stagflation. It's what we had in the 1970s, and it's what we're seeing right now. And that makes a very, very tough time for the markets.
Do you think we're in the biggest bubble of all times?
No, I do think. Well, it depends on how you look at it, but I do think it's a big bubble. We're coming out of it. The bubble has burst a year ago, but it takes a couple of years for these things to unwind. So I guess my point is in the late 1990s, in the 1999, 2000, that was probably a bigger bubble, at least in the stock market. The problem is that in the credit markets, it's a bigger bubble. It's the biggest bubble of all time. And we got $11 trillion of corporate debt, by far the biggest we've ever seen. And, a lot of this debt, which is really scary, that people don't talk about enough. And they say, oh, look at these companies, they're buying back stock. How good is that? I'm like, yeah, it's good on a short-term basis. But all these companies have spent billions of dollars borrowing money through the bond market. In other words, issuing bonds, borrowing money from the public so they could buy back their own stock. I mean, everybody's like, oh, it's great. Well, it's great for the short term, but longer term, what do? And they say, well, interest rates were so low. Doesn't matter. You take on all this added debt. And again, it's by far the biggest debt ever, corporate debt. And you use it for things that aren't going to help you service that debt. And if you take on all this debt, but you're building new factories and building or opening new stores so that you have income to help service that debt. In other words, pay the debt off every month. If you're not doing that, it doesn't matter that interest rates were low when you issue the debt. It's still a burden you have. It's not the kind of that it's not good debt. I guess is my point. There is such thing as good debt. I mean, we all know that. I mean, if you go out and buy a house and put 20% down, and you got a job to be able to pay for it. I mean, if you put 2% down, as we saw 15 years ago, that wasn't good. Zero down. But if you put 20% down or more, whatever happens to be, you pay it. That now allows you to buy a house. Then you're buying vacuum cleaners, you're buying dishwashers, you're buying couches. All that stuff is good for the economy. But when you put on bad debt, it's not good. And so we're facing, I think, a much more difficult problem than people realize in terms of the markets. And it reminds me so much of what happened in those late 1990s, when all that liquidity came into the marketplace. That liquidity was different. It was kind of it was definitely behind the scenes. It didn't have a massive QE program, but it was just as big, if not bigger. And what we had was that This was, flooded. The system was flooded with this liquidity to save us with the problem of Y2K. Well, it did save us from the blow up that could have taken place in Y2K. But guess what? Once they removed the liquidity, once we got past the year 2000, and we realized that they had fixed it in time, they pulled the liquidity, and what happened? The market, the Nasdaq went down 80%, the S&P went down 50%. The same thing happened this time. Massive liquidity was added to the system to save us from the pandemic, which had basically all but completely shut down the global economy. That's great. But now that the economy is back on its feet and the Fed is pulling that liquidity away, the market's going down. It's rebalance. We're going through this recalibration of what really is. The market got pushed to all sorts of risk assets, got pushed to levels they never should have reached, given their underlying fundamentals. The obvious one we saw with Bitcoin and other cryptocurrencies, they may go a lot higher over time. Maybe they'll go to 1 million that Kathy Wood says it's going to go to, but it got there way too fast. It's got to come back down. That's why the stock market's trading at 18 times earnings. That is expensive. Even though the stock market has come down a lot, it's very expensive, and you have to come down and get it in line with the underlying fundamentals. That's going to take time. That's why we're going to have a lot more volatility in 2000. We're going to continue to have volatility in 2023, and it's going to be a lot rougher than I think a lot of people think. Which again is great for those of us who are active traders.
Yeah, no, absolutely. This is a trader's paradise. So I appreciate the high level talks, and we will have more of that. Let's go ahead and show the members, Matt, how you've been able to profit from this volatility.
I will do that. And just one thing, because I just like to cover is real quickly is just my background. Very quick. A lot of people have heard me speak before, and they know what it is. But just, and then, again, I'm a strategist, but I'm not your typical strategist where I didn't come from a theoretical background. In other words, I wasn't an economist. I wasn't an analyst. Nothing wrong with those people, but they are more theoretical. They talk about what things should be 3 years, 5 years from now, or even a year from now. I was a trader for 25 years on first 25 years on Wall Street at Solomon Brothers, which was the biggest, most important trading desk on Wall Street in the 70s, 80s, and 90s. I wasn't there for all that. I was in there in the 80s and 90s, but I was there for 15 years. And same with Merrill Lynch, the biggest trading desk and one of the most important ones on Wall Street for another almost 10 years. So 25 years. And talking to the biggest institutional trading desks on Wall Street, the biggest mutual fund, biggest hedge fund, Fidelity Mutual Fund, BlackRock Hedge Fund, big banks, insurance companies, other money managers, endowments, Harvard University endowment, things like that. Really sophisticated traders. So we really learned about what I don't care about what theoretically should happen, what is happening, what is taking place right now, and what is going to take place in the near future. And that has allowed me to see key turning points in the marketplace rather than focusing on the theoretical. I might hear so much now. I mean, we've heard so much this year with professors. I mean, very well respected professors, college professors who have done very well and written great books and all that. They spent the whole year saying the Fed shouldn't be raising, the Fed's going too aggressive, they're doing this. I don't care what the Fed shouldn't or shouldn't be doing. I mean, don't get me wrong. It is important to voice those opinions, but you can't invest that way. Some of these people just kept saying, no, don't worry, go ahead and buy the market because the Fed will have to, they're going to have to, they're going to have to stop tightening. Well, they didn't. And I knew they weren't. And I took what was actually taking place, not what somebody should be taking place on a theoretical level. And that's how we were able to profit. And that's how, I turned bearish this time last year, said raise cash. And as we got into the early part of this year, we started making a lot of negative bets. But we made them on both sides. Markets moving both ways. We see bear market rallies. I'll show you here shortly how we made it in the XLE. How we made money both on buying calls and buying puts. But that's what you have to be. Again, we all want that big. We all have that bucket for long-term investment, and we all should have that. But if you have another bucket and you have the time and inclination to invest and trade a little bit more actively, you can take advantage of these moves because they really, really can be very profitable. Especially now that we have the tools to take advantage of it. It's not just all those options I talk about, but we have ETFs, inverse ETFs, leveraged ETFs, inverse leveraged ETFs, et cetera, et cetera. So it works out really well. Anyway, I just we'll talk a little bit about that now. Talking more specifically on what we do and how we do it. Whoops, let me just pull up Sorry here. Oh, here we go. Okay. And let me just pull it here for my apologies. Take a second. But I'll just show you a situation here. What I tried to do, and I just wanted to look on my little notes here because I want to make sure which tablet I have here. I've got a zillion, about 100 of these things, and I just want to make sure I pick up the right one. And we'll start, but we'll show you several, quite a few of them. Here we go. Here we are. Okay, great. And let me just blow it up so you can see it better. There we go. Okay, now this is, but what I try to do is we those fundamentals I talk about, the theoretical fundamentals, those are very important. Of course, I follow them very, very closely and spend a lot of time watching them, analyzing them, because the market does trade on fundamentals. The problem is that too many people think that the market's always right. It's one of the sayings on Wall Street. It's probably the worst old saying on Wall Street ever. But what it really is that the market is only always right eventually. I mean, we all know, was the market right at the top in 2000? Was the market right at the top in this past January? Was the market right at the bottom in 2009? Of course not. These stocks will go way out of whack, and that's why we take advantage of it. When things get way overvalued because people get too excited about it, or they get way undervalued, and it's not just the market, it's individual stocks, sectors, groups, etc. That's what we want to be able to take advantage of. So I use those fundamentals to a great degree, but I want to look and see when they got out of whack. And by that we use a lot of technical analysis, which is really fundamentally based anyway. I'll go into that another point, but another time. But if people just think it's just a bunch of lines drawn on a chart, it's not. And I mean, I'll delve in it right now, real quickly, just to say that you think about it. If you are a company and you are you've been down and out for a long time, and you're an institutional investor, and you're looking at this company, it's done nothing for 2 years. All of a sudden, things start getting better. And you have your analysts have been looking at the company, and all of a sudden the company's gone from 2 years ago they had to lay people off, close factories, things like that. Well, now things are picking back up. Well, it takes time for turning things around before their earnings actually get better. They've got to retool those factories, maybe build a new factory, hire new people, train those people. You're not going to see the immediate pickup in earnings for 6 months, or at least 6 months, 9 months, or even a year. And what happens is that, but the sophisticated institutional investor, they see this in advance. They see that, hey, this company's customers are asking for more product. They're seeing that their suppliers are giving them more tools to make their product. And so you sit there. So these analysts, they go to the portfolio manager and they say, hey, this stock. Don't wait 9 months for these earnings to turn better. It is going to turn better. I mean, their orders are through the roof. They're just not able to fill them yet. Well, guess what? The individual investor doesn't have that kind of army of analysts to tell us this stuff. So what we do is we look at the charts because the stock starts moving higher, and we say, hey, something's going on there. It's starting to break out. And so that's why I always hear that stocks move and the market overall moves 6 months in advance of a turn in their fundamentals because people see what's going on. Same thing happens on the opposite side because you say, oh, geez, we'll wait till they start laying off people. Well, people are human. I mean, managers are human. They don't want to lay off their employees. So the things start to drag down. The stock starts going down. And so the stocks also turn down before the real thing hits. So this technical analysis is very, very important. It is fundamentally based, and it's very, very helpful. And I've said many, many times, all the top and most successful hedge fund managers in history, certainly the last 25, 30 years, have all used technical analysis extensively. It's not what they use solely by any stretch of the imagination. Some use it more than others, but they all use it to a certain degree. And it's very. Then we also look at sentiment, and we look at when you get too many people that are bearish, usually a sign that the market can't go any further. There's nobody left to sell. Too many people are bullish. Just the opposite. Same thing with positioning. Too many people are long a stock or a group. It means it can't go any higher because there's nobody left to buy, etc. We combine all these things. And then I use my 40 years of experience on Wall Street to try to help us. So just here's an example, perfect example of what happened here in Apple Computer this past spring. Remember when this whole debacle in the cryptocurrency markets that's been taking place recently. But of course, we saw the big crash in the cryptocurrency market this past spring, and we all heard about that. They were getting margin calls and such, the leveraged investors, and crude oil. I'm sorry, and these things just fell through the floor. And what happened was these things weren't liquid enough. So these markets really started getting. So these people who were getting margin calls and say, "Hey, you've got to meet your margin call. You owe this money." They couldn't sell enough. Even Bitcoin, even the ones that were somewhat liquid, like Bitcoin and Ethereum. There are other ones that weren't anywhere liquid enough. So they had to go out and sell something. What did they own? They owned stock. They owned tech stocks. I mean, these cryptocurrency players weren't using. They didn't own General Motors. They owned tech stocks. And that's what I saw. I saw what was going on. I saw Apple Computer, and I said, Jesus, stock's down 10% in a week, and there's no negative news. I mean, Apple Computer doesn't go down 10% for no reason. It can go, sure, it can bounce around all the time, 2 or 3% here or there, but 10% straight. And I realized this is what, from my experience, I'd seen this before. When illiquid securities get margin calls, they have to sell what they can sell. And then I realized it was Apple Computer. The stock was down 10%. Well, sure enough, on April, let's see down here at the bottom, see May 12th, on May 11th, these cryptocurrency has been going down, down, down. May 11th, it looked like it got washed out. And sure enough, on the 12th, the cryptocurrencies traded sideways. And yet Apple, which had already fallen 10%, fell again. And I'm like no, there's no news out here. I checked all things. I spent the whole day trying to figure out what was going on. I realized there's nothing wrong with this stock. This stock's going to bounce back. So sure enough, late in the day, I went out in our chat room and I said, we're going to buy, and I get very specific. I don't just say, hey, you ought to look at the Apple calls, or hey, you ought to buy Apple. Very specific. We came in, it was on a Thursday, and they said, buy the Apple, May 13th, $143 calls. So it was at the strike price, exact strike price, the strike price is 143, exact expiration date. We bought on one day with they were going to expire the very next day. But I knew that if the cryptocurrency forced selling margin calls had come to an end, this stock was going to bounce in a big way. Sure enough, now I didn't get the exact bottom, but sure enough, by the next morning, late morning, we were up over 400%, and we made that plan. We go ahead and took the profits. If I'd held on a little bit longer, we would have made more, maybe even up to 500%. But the thing is, if you're going to beat yourself up after making 400% in less than 24 hours, and beat yourself up because you didn't make 450%, it's one thing if to beat yourself up because you made 10%, you could have made 100%. But when you've already made 400%, you're going to drive yourself nuts if you try. If you're going to beat yourself up out of that. You make that kind of money. If you're not going to get almost the top and almost the bottom, you'll never get it. And you'll just drive yourself nuts. You shouldn't be trading if that's what you do. So this worked out really well. But this gives you an idea of what, the way I try to work things. Now, let's give you some other examples here. I want to just hit escape here real quick, because I'm going to get to the correct, here we go. Here's another example, and I just want to get to the right one. We can show you. I mean, as you can tell here, I have all sorts of different examples. But here's the situation where China, and we'll talk about China because they're having some lockdowns here because weigh on the markets as early as tomorrow. I'm going to blow it up so you can see it better. But and again, I'm going to show you some individual stocks and some index options that we've played and made a lot of money on. But here's the situation where I just want you to show you an example that we move outside of the marketplace of just U.S. stocks. I mean, back in 2021, everyone wanted the new meme stock, everyone knew hot stock. Well, that's fine, but if you're folks, that's just luck, okay? First of all, I just want you to know before I go further, it says last weekend's chart. That was last weekend's chart when I made the chart. That chart was I'm sorry, this chart was made in March, so it wasn't this past weekend's chart. Anyway, this is a situation where China's market had been getting clobbered, right? Again, this is the way my mind works and why I try to help people make money. I was negative all the way through here. And the reason being because China was cracking down on all sorts of different industries. They started off with Jack Ma and Alibaba, but they went to other areas of technology. And every single month or every 6 weeks, they went out and went after another group. It would be the gambling area, the gaming area, the digital gaming, employment, education area. Every single month there was another group, and they were just cracking down, and the market was going down and down and down and down. Finally, though, early this year, it got crushed, absolutely crushed. And the reason for that was the SEC came in and said, there's a good chance we're going to delist some of your companies. Now here was China. They're like, they knew what they were doing. They're like, yeah, we're cracking down, and we're just going to cause some pain, and then that's that. But we're doing it to ourselves, and it's what we want to do for the variety of different reasons. Here it was like, wait a minute, the U.S. is doing this to us. We don't want that. Okay, so I knew just from again experience and following geopolitics all my life, or most of my life anyway. I knew this was not going to fly. The Chinese were no way they were going to let this stand. They were going to have to buy their market, and being a communist country, they can come in and do whatever they want. They can manipulate their market in any which way they can. So that was kind of the fundamental side of things. The market was getting too cheap. But then also on the technical side, we use the RSI, which is here we go. So I did this again the other day. I couldn't remember what RSI stood for. How funny is that? Hold on a second. I use it 5 million times a day, but hold on here. Shoot. Okay, sorry. There we go. Okay. There we go. There we go. RSI. There we go. Relative Strength Index. How about that? What a dope I am. Okay. There we go. Okay. Let's pull my stuff back up here. There we go. There we go. Okay. So the Relative Strength Index, here we go. RSI is just have a brain fart there. I apologize. That's kind of funny. But anyway, but see how it is when it gets down to the green, it gets down to this green line. Okay, that gets down to the 30 level. That's a buy. That's a green for a reason. Sorry. So it gets down to the green line, and it's 30, right? So that's buy. It gets up to the top line, the red line. That's sell. Get out. No. Stop buying. Stop. Green buy, red sell. So you can see it got up to the red line here, sold off. Got close to the red line here, sold off. Got way above the red line here, sold off. Remember here, it got to the green line, down to 30. Great buying opportunity on a short-term basis. Got down to below the green line. But these are nice little bounces too. This is not just like 3 or 4%, like a 10% bounce. But look how oversold it got here. Ridiculously oversold. Got to 14, the most oversold I had ever seen. Second most oversold I'd ever seen on any chart in my 40 years. And so I said, we got to go in here and buy this market. So again, we didn't have to call Hong Kong and get a special account set up. We just went to the FXI, which their op call options are quite liquid. And we came in, and sure enough, the next day, their market, the China market, rallied 27%. That'd be like the Dow Jones Industrial Average rallied 27% in one day. Okay. Well, what we did, there we go. But what we did on the 15th, again, this is the 15th we traded, okay? We bought the FXI March 18th, okay, because that was the straight. They only expire once a week. March 18th, $30 calls. We bought these late in the day mid to late afternoon on the 15th. So in other words, we bought them on the 15th, but they didn't expire to the 18th. That's why we had the March 18th. We bought them here. And sure enough, the next day you saw the market. See, the market saw that 27% rally. These things went up. At the opening, they went up over 1,000%. And say, well, why didn't you just take profit right there? You're up 1,000%. Didn't you just say that if you make a big profit, go ahead and take it. Don't worry about it. Well, that's what I would usually do. But in this case, again, my experience, I knew that the Chinese government was the reason why this market was up. They were buying it themselves, and they weren't going to just buy it for. This wasn't a meme stock. I knew this was not a meme stock that was just going to rally for several hours and maybe roll back over, or just a day or two or roll back over. I knew it would continue rallying. So we held on to it for several hours. However, it got to about 11 o'clock, and I'm like, oh my God, we're up almost 3,000%. We got to take some chips off the table. So sure enough, I said, this is probably going higher, and I think it's going higher, but I'm going to sell a half. So we sold half, basically 3,000%. Well, at the end of the day, again, now they're up over 8,000% at the end of the day. And I was like, whoops, sorry. At the end of the day, it's like, they're up almost 8,000%, which means we've made over 5,000% on the whole thing. I got to take the profits. There's just no way. And so some people, and I did say, I did tell people, I think this is probably going higher, but I just can't. in good conscience, tell people to hold on, because this thing could open up, maybe China will wait a couple more days and let the thing market come back in before they buy it again. There's just no way. And some people held on and actually made over 10,000% on the whole thing. But for us, we made 5,000%. Now, again, this is not something that happens very often. It's not our only one. We've had several opportunities where we've made over 1,000%. A couple this year. We had one last year in Viacom, which is no longer exists. They were because they were split up, to Paramount, et cetera. But the point is, this is a trying thing. We take a fundamental analysis, technical analysis, experience, and kind of combine it together to make some of these big trades. So that's just one example there. I just want to go here and move again. Give you some more examples just to let you know this is not something. Again, we're not making 5,000% all the time, okay? But we are doing it every month. You're going on, and we do it in many different areas. And here we go. I'll just pull up here. 79. There we go. This was the Viacom trade I talked about. Let's bring that real quick before we go on to some other trades. But again, I'll blow it up for you. Bang. Viacom. This was a similar situation. It was a meme stock, and this was actually 2021. And it was actually before the chat room was open. We did it in the tier 3 stock picks report. But here it is. Sure enough, the stock. See again, the RSI got ridiculously overbought. See how it got overbought here and sold off. Overbought here, sold off. Overbought here, sold off. Look at this. How it got up to 97. I'd never seen anything that high. I was like, this is ridiculous. Let's buy the puts. And Viacom, sure enough, the next day we sold half for 2,500% gain, and sold the other half with a 5,000% gain at the end of the day. And then you can see how the stock fell 60% the next day. So we made some real nice money there. But these, again, I just want to show you how we're, oops, let me just see. There we go. And again, so we do some individual stocks. Oops, do I have the right one? Yeah, perfect. Oh, wait a minute. I missed there. Okay, Amazon. Here was the other one. This was actually one, and talk about the chat room. It's not just me putting all these ideas in there. We have people in the chat room who are giving great ideas all the time. Here was one where I told people, said, Matt, what do you think of Amazon here? They were just about to split. The stock was just about to split. I'm sorry, it was just about to split, right? And I said, and the person said, in the past, whenever they split the stock usually rallies going into it. And I was like, I really like this trade. I'm not going to participate myself like an idiot, but I said, it's a good one. Go ahead. Well, sure enough, a bunch of people in the room, in the chat room, did take advantage of it. And and I said some sold as much as 500%. Others held on to it, made over 1,500%. So like I say, it wasn't just me. There are people. We are talking to each other all the time in this chat room, and it worked out extremely well. Whoops. Okay. And again, here's another situation where advanced micro devices. The chip stocks were getting clobbered this year. Again, I'm going to show you how there was a situation. We bought the FXI, then we bought Apple Computer. Here's another individual stock, advanced micro devices. I knew it was getting very oversold on a technical basis. And we went in and bought them. And literally in one day, we held on to them for, let's see, a day and a half, almost 2 days. We made 146%. So again, I'm not trying to claim every single time I make 2,500% or 5,000%, but you make more than double your money in just one day. This is the kind of things we're trying to do. Now here's one, SQQQ. They're that's the options. Those are the leveraged ETF on the leveraged inverse ETF on the QQQ, which is the Nasdaq ETF. You see, I don't know if you see the girl, the young lady in the commercial who dives into the ice bucket and jumps out. They're talking about the QQQ. It's very funny. I love that commercial. Anyway, but again, 400%. This is something we did in June. Oops. Oh, okay, I just want to go on here. Here, okay. Now what happened here? So I said, so now we're going back to some groups. Again, I showed you the SQQQ trade. So we did that on an index. We did it on some individual stocks. Here is the XLE, which is the oil ETF. I had been bullish on the energy stocks since October 2020. Nobody else was bullish on it. People were telling me I was crazy. And sure enough, 3 or 4 months later, Goldman Sachs, Morgan Stanley, they all turned bullish on it. At the end of 2021, they said, look how smart we are. All these stocks are up 50%. And I said, well, that's great, but ours are up 120%. So we did more twice because we got in at the key turning point. We're not like most of Wall Street who waits until it's safe. Okay. When we see it, when we see the opportunity, we jump on it. However, fast forward 18 months, I came in and said, hey, oil, as much as I like oil on a long-term basis and the energy stocks on a long-term basis, I said, don't take profits on your individual stocks. We can trade around our positions. Okay, so we're going to buy some put options. Sure enough, we went in, bought the XLE June, again, exact June 17th, $19 puts. We bought them on June 8th with a week and a half to go. I hadn't bought them, held on to them for several days, and then sold half of them up 500%. Then it got knocked down. I was like, oh, geez. And it bounced back again. We sold the other half at over 470%. So we made well over 500% on this trade. And again, 500%, think about it, that's over 6 times your money, 6 times your money. I mean, remember about that. I said, wait a minute, that's 5 times your money. Well, I was like, no, if you're up 100%, you've doubled your money, right? So I do the math there. But the point is that, again, here's another situation we did in the options market, wheat, okay? WEAT is not a misspelling of the word wheat. It's the correct ticker symbol for the wheat ETF. And I saw that, remember how commodities went through the roof in the spring? They came crashing down in the early summer, but they got oversold on a technical basis. We went in and bought the wheat July 15th, $9 calls. 3 days later, 250% gain. Okay, that worked out really well. And going on, here's TLT. This is the Treasury bond futures. Okay, we bought the calls in that one back in July. What have you done for me lately? Believe me, we've had plenty of trades here more recently, but I'm just trying to show that we do it in a variety of different assets, and we do them. And we've been doing it for months. Here's the TQQQ, which is the ETF that is the leveraged ETF on the QQQ to the bullish side. The SQQQ is the bearish inverse ETF, the bearish leveraged ETF. This is the bullish one. Again, on July 1300. LABU, here's the leveraged ETF on the biotech industry. The IBB or the XBI. Those are 2 different ETFs, but this is the leveraged ETFs, 3-time bullish. Excuse me, we bought this in August, 800% in just a day, 800%. Again, we don't make one at every single one. Whoops, but those are just, and I'll just go on here. Here's more, here, UUP, we made 100%. This is in September, that's UUP is on the dollar index. QQQ, 120%. Those are just the regular. That was not the TQQQ is the levered ETF. This one we just bought. Again, here's another one where we made 50%. Again, they're not all huge home runs, but you make 50% in one day. You're doing well, right? So we know a lot. So just wanted to give you an idea of what we've been able to do on a very regular basis going through. I mean, this past week, what happened was. It was actually the week before the holiday week. We came in and we bought some. It was this week. I'm sorry. On Monday, on Tuesday, at the very beginning of the week, we bought TQQQ calls because TQQQ puts, because I really thought that the Fed minutes might be disappointing and really and hurt the market. Well, but what we did is we put on a strangle. We don't do too much in the way of this is very basic stuff. We don't go too much into the real wild trades. There's condors and things like that. We just do basic puts, calls. Once in a while, we do a straddle or a strangle, and that's when you buy this because we try to hedge ourselves. That's when you buy the put, a put and a call of the same asset, or the same with the same expiration date. In a strangle, you have different strike prices. A straddle, the same strike price. So you're looking for a lot of volatility, and the idea is that you'll make way more on one than you'll lose on the other. And so what we did this past week, we made it on both. We came in the TQQ, the market opened lower on Tuesday morning, very, very, very lightly lower. We made a little bit of money, about 10%. But I said, I thought this market would react much more negatively to this situation. It didn't. Let's go ahead and take. Actually, I thought it might even be a loss, but then when we sold them, nope, we made a slight gain, but we held on to the other side of the trade. We held on to the calls because the market looked good. Sure enough, we saw a strong rally on Tuesday, and we made 50% on those calls. So 60% on the overall trade. So you can see that we do some hedging, we do some trades in many different ways. But again, we try to use fundamental analysis with a macro edge to it, technical analysis, sentiment, positioning, et cetera, to see where where we can get these great opportunities. And if you get a thing today, I mean, I think this week we'll get a chance to talk about a little bit more shortly, but what I'm looking for this coming week, there's a lot of things could happen this week. I don't know if there'll be a catalyst or not, but we have all sorts of different stocks, ETFs, different asset classes that are key technical junctures. And if you want to check out, I put on the Maley Report, which you can get on the MaleyReport.com. It's a separate subscription, but I put a free account for my weekend piece this week, and you'll look at how I talk about gold and the dollar and natural gas, which is looking really good on the charts. How John Deere, which is a great company with just reported great earnings, but it's way ahead of itself. I don't want to be chasing this, and I might even be looking to buy some puts in the stock for a very short-term trade, even though I love the stock. And believe me, when you hear this, if you own John Deere, do not sell it. That's not what I'm saying. But you might want to be able to trade around it. So this is the type of stuff that we're looking at on a couple of different levels. And again, it also gives you an idea. Again, the MaleyReport.com, it gives you an idea of what my macro what my macro view is, which is I think is important to what we're going on, because I just don't think people are spending way too much time trying to figure out what the economy is going to do. And my point would be, like, the economy, I believe, is going to get worse and slow down, and earnings are going to have to go down. But even if it doesn't, the market is so far ahead of itself, and without the steroids that the Fed has been providing really for a dozen years, but obviously in a big way since March of 2020 with the pandemic. That was what took the market way above its natural or its fundamental values. So now it's got to come back down. We're trading at 18 times earnings. It has to come back down. If we keep earnings at where the estimates are right now, which it's going to be very, very difficult to do, we still got to drop to 3,400 on the S&P just to get to what happens during bear markets. The thing is, bear markets are natural, and people fight them. People on Wall Street, because they're paid to be bullish. Most people on Wall Street are paid to be bullish, okay? And they give you that nice, these same people. I mean, when the market's down, how much percent? They're still giving the same arguments as to why you're actually buying stuff with both hands. It's don't get me wrong. There will be an unbelievable opportunity in the next year or so, but it's not. I think we're going to hit lower lows, and it has to do with the fact that people need to accept bear markets are natural, recessions are natural. This whole thing that the Fed doesn't want a recession is ridiculous. Okay, take that back. They don't want a recession, but they're not, as many people try to say they're stupid, they're not stupid, okay? They knew when they started the liquidity program that the market was going to go artificially high. Because the economy's doing this. Everybody knew that the stock market was way ahead of it, okay? Was way ahead of the economy. And they were okay with that, because because we're in an emergency situation, that's okay. And eventually the market, the economy will play catch up. The problem was, once we got past the emergency stage, they kept the emergency level of liquidity. And so it could never catch up. It just kept going, it couldn't catch up. So at some point, so now that the liquidity has been pulled away, the thing has to come back down. We want to meet somewhere in the middle, but if the economy is starting to turn back down, again, the lower has to. But just look at valuation levels. You look at the S&P 500. It's trading again at 18 times earnings. Every single bear market since World War II, probably since before World War II. I've only looked since World War II, but every single one has always swung from whenever it started expensive, it always went to the other extreme, to inexpensive. At least 15 times earnings, many times much lower than that. To get to 15 times earnings, you got to drop to 3,400. But because the consensus right now is looking for $230 on the S&P 500. We're not going to get there. I think the earnings are going to have to come down, because I think we're headed for a recession, and every single recession, during every recession since World War II, earnings have gone down that year. Okay, so 2023 will be down year for earnings. That means that we're looking at something closer to $200. That means the market's going to have to fall in the low 3,000s, if not lower, before it bottoms out. This swings. That's the way the world works. Okay, there's a cycle to everything. We have 365 days a year, 12 months out of the year. There's a cycle. We have, every single day is a cycle, right? It gets dark, we go to sleep, or forests grow to the sky. Then they get cover up too much of the underground. The underground gets real dry. Lightning goes through. Burns. Everything's in cycles. Each year, every year we have the 4 seasons. It's not just if sports teams. You think, oh gosh, our team is so great, it's going to be great forever. Well, they're not. Okay, they have cycles. That's how the world works. And the Fed understands this, and they knew when they pulled that thing that they were going to that was going to cause a slowdown in the economy and cause the stock market to go down. They knew that. Okay, and they would like to avoid a recession, but that's why they're saying now that we're probably not going to be able to avoid a recession. They've been saying that for a couple of weeks. Okay, because they're setting the pace. They're trying to set expectations rightly. To think that the Fed will do whatever it takes to avoid a recession is ridiculous. I mean, they know that's it's natural. It's what capitalism is. Anyway, I'm starting to drone on here. I don't want to get onto it, but the fact of the matter is that we are still, people focus too much on whether the economy is going to fall in a recession or not. Doesn't matter. If we don't fall in a recession, the stock market's still going to have to come down from where it is now. If we do, it's going to go falling even further. And of course, now what the Fed didn't count on was the invasion of Ukraine. That's caused stagflation, made the inflationary problem a much bigger one, and I don't think that's going anywhere anytime soon. So again, most people on Wall Street, their job is to stay bullish, and so that people keep their money at that mutual fund or at that bank or at that brokerage firm. They don't pull it out. And it's the right thing to do because over the long-term period, that's the right thing because the markets tend to go higher. I mean, the market spends a lot more time going up than going down, and it will go higher over time. But when we come into these situations where we can do the active trading in a very good way, we want to take advantage of it and not play that stupid game, the la-la game, and say, they always say, well, every time this happens, the market tends to bottom. Every time this happens, the market tends to bottom. I'm like going, the one thing that is absolutely perfect record on, okay, is that the market always gets cheap. Okay, when you have a bear market and recession, it never bottoms until the market becomes cheap. And I'm going to show you something. I told you about the PE ratio of being 18 times earnings. It has to get to at least 15 times earnings. But let's look also at let's look at the S&P 500 price to sales. Okay, we can't have, people can fake their earnings all the time. I'm going to say fake. I don't want to say it, but they have, they take charges. They do these things. Whoops, what happened here? They take charges, and they can, fiddle around with their number. Okay, here's price to sales. Okay, they can fiddle around with their earnings and make them look better than they really are, or even in some cases make them look worse if they want to throw out the kitchen sink and get everything, get all the bad news behind them quickly. But look at this. Here's a long-term chart on the price to sales. You cannot fake sales. There's no charges against sales. It's like either your sales or your sales. They are what they are, unless you're completely lying. And if you're completely lying, you're going to go to jail. These are what your numbers are. Okay, so there's the price to sales. Right now we're trading at 2.3 times sales. Okay, how expensive that is. Okay, at 2 times. Rodrigo asked me earlier, is this the worst bubble ever? In price to sales, yes, way more than the tech bubble. But look at it right now. We are now trading at 2.3 times sales. And let's just make a color to make it stand out. Look what we're looking at here. Hey, we're back. We're not at where the market tends to bottom. We're sitting where the market usually tops. Okay, this just got so outrageous. But here, the top in 2018, just before we had, and they say it wasn't a bear market because the S&P only fell 19.8% instead of 20%. But same thing. Okay, the market got hit hard. See what happened just before the pandemic hit? Boom, right here. Way higher. I mean, way more expensive than it was in 2007, just before the great financial crisis. And the same at the top. Okay, not at the bottom, at the top. We're looking at something down near at least 1.5 sales, or probably lower. Let's see here. Let's take this out of the way. Again, you had to get down to 1.2 sales. This was a deep. I don't think we're going to be that bad. We get the Great Recession, but you get down here, you've got to get down somewhere near 1.5. This market is expensive. So we need to be very careful. We're going to take advantage because it's going to take a while for us to get through all that volatility and work it down. And the Fed is, the Fed is doing these things where they keep, they're playing good bad cop. We're going to, over the summer, they said some good things. They don't want the market to fall all at once. They want it to happen gradually. because if it happens all at once, then you really got a big problem with the economy, and they want to avoid that. Remember, this sell-off here, huge sell-off, 80% in the NASDAQ. We won't get that back because the market wasn't as expensive back then, at least on a PE ratio. But we have to remember that we did not have a deep recession after the dot-com crash, okay? Because it was what caused the bubble was liquidity. When the liquidity was removed, it wasn't like here when the disaster had to do, it wasn't a lack of liquidity from the Fed. It had to do with, geez, okay, I'm sorry, there's stuff in here you can't see that are on my screen. But this had to do obviously with the financial system being in peril. Here, this was not the financial system. Hopefully that's not the same thing as the case now, or it's not the financial system, it's other issues that are affecting us. And but that still means the stock market has to come down and still has to come down a lot. But these people say, don't worry. And that's the other thing. At the beginning of the year, it was absolutely asinine what some of these people were saying. Say, oh, this is not the same as 1990. It's not the same as 1999, 2000. I was like, so what? That's like saying, oh, geez, somebody's really, really overweight. They don't weigh, but they only weigh 400 pounds. They don't weigh 550 pounds. They're still okay. It's like, no, they still need to lose weight. They still need to lose a lot of weight. And that's what we saw this year when the market was trading at 22 times earnings and 3 times sales. It had to come down. The only way it could stay up was through the steroids that provided. And just like it is with a weightlifter, you use steroids, you're going to get a lot stronger. When you remove the steroids, you're still going to be strong. I mean, as long as you don't take them for too long, you're still going to be strong, but you're never going to be as strong as you were without those steroids. That's what the market has to do. We don't have the steroids anymore, and guess what? They're not coming. And the only way they're coming is if we have another major crisis. When that comes, and if the Fed pivots at that point, well, great. That'll be good. The problem is the stock market will be a lot lower than it is right now when that happens. So we need to be careful of that. So that's really what what I'm trying to focus on right now. I don't know if Rodrigo is still there. Let's see here. I just want to look at some other things here. Okay, so let's move up. Oh, there's my red screen. Okay, I want to talk about a couple of things that are coming up this week that we want to focus on. Okay, here is John Deere. Okay, as we know, they reported good numbers. Or for those who know, if you don't know, you might not know, but John Deere, what they do is like their farm equipment and such, but a lot of heavy equipment in terms of road building, and you see that their stuff. The Caterpillar tractor, of course, is one of its main competitors, and we see their stuff all over the place. Whenever you see road construction or whatever, you see that you see the Cat tractors all over the place. But see here, I'm going to put the zoom. Let's go here. Okay. Now, oops, I got to put this on home. Oh, there we go. Oh, didn't work. Hold on a second. There we go. Okay, now you can see it a little bit better. See how it's making up this, getting up to this high here? That looks really good. Remember we talked about that RSI, okay? The relative strength index, which I can't believe but here we are. That purple line there's the 200-day moving average. It's breaking above that. It's very close to making a higher high. If this thing can break out above 450, 445 really, that's going to be really bullish. But again, look at this. See this RSI chart? We're going back to here. See it here? How the stock came down after it got overbought. See it here? Came down, here, came down, here, came down a little bit. This might only be a short-term pullback, okay? But it's getting overbought. And let's look at another stock. I'm sorry, another stock and another chart of the stock. This is the Bollinger Bands chart. Do you see how it's getting? Okay, what this is, let me get some of this out of the way so you can see a little bit better. This upper line, okay, this green line, that's the 20, or I don't know, it's a gray line, I guess, is a 20-day moving average, right? The purple line is when you get 2 standard deviations above that 20-day moving average. The green line is when it gets 2 standard deviations below that moving average. And again, you see how overbought it's got here, so how extended. So you combine that with the relative strength index, the RSI, and you see how the stock's getting overbought. Again, I like this company. There's a lot of reasons to like it. And believe me, if it breaks above 450, it is going to fly. But my feeling is that, and would be actually better for the stock if it digested its over and worked off its overbought condition on a short-term basis, and then pull back a little bit. Now, obviously, if it gets crushed, but you can even go down. That's a lot. I don't know that it'll go down that much like it did in August and September. But if it goes down and then breaks back above that level, it's going to be much, much more bullish. We'll have much more confidence. I'll tell you. I guess my point is that if you own John Deere and you like the stock, keep holding on to it. I'm not saying sell it. But when we're in the chat room next week, we're going to be looking at opportunities and see if this thing rolls back over. If it does, we're going to buy some puts in it and try to trade around the position. That's what active trading is all about. We can have stocks that we like over a long-term basis and still in the options market, we can say, hey, geez, I love this stock. I'm going to own it for 5 years. But every once in a while, when it gets overbought and extended, we can buy some puts in the thing, see the stock go down, take those profits and put it right back into the stock again, and then just let it go and let it run. Okay, it's a great way to move around it. But one of the things I just want to talk about here, and we talked, I just talked about the RSI, Relative Strength Index. We talked about the Bollinger Bands. We'll talk about the MACD charts, which is another one, and then we talk about technical patterns. Head and shoulders patterns, rising wedges, falling wedges, symmetrical ascending triangles, descending triangles, etc. And we really, the chat room, we really try to use education to a big degree so people can learn about why they're doing it. I go in and put the ideas in there, the ones that I like, but I tell you why I like them. And it's all about education. So we talk about things like the Bollinger Bands chart or a relative strength index chart. Stochastics is another one that we have. We don't want to get too. I mean, believe me, some technicians get way too make things much more complicated than they need to. And we just talk about key issues. And what we do in the chat room is every Tuesday at 11:30 a.m., 11:30 Eastern time in the morning, we do a Zoom call much like this. And it goes about 45 minutes to an hour, and we talk about it. Again, educational things. So one time there was a misunderstanding for some people in terms of what a head and shoulders pattern really entailed. Went over that. We talk about whatever happens to be. This past week we talked about where to take profits on things. And there's another thing too is like one of my favorite things on the macro issues. And again, this is something I've written in the Mailer report, is that all these people are talking about when's the Fed going to pivot? First of all, they're telling us they're not going to pivot, and you need to pivot. Pause is not a pivot, okay? And one thing for damn sure is that going from 75 basis point rate hikes to 50 basis point rate hikes is not a pivot, okay? The other thing that's so important to realize is that when interest rates top out, that is not. Oh, I said take it back. When interest rates top out during a bear market, that is not when the stock market bottoms, okay? I know they try to say that, and it's just flat out wrong. Okay, what happens is interest rates start to move up, and it causes the market people who expose the market as being expensive, and people worry about the economy because interest rates move higher. It means your mortgage is going to be higher, your auto loan is going to be higher, et cetera. People are going to borrow less. People are going to be et cetera, et cetera. That causes the markets to roll over. The problem is at some point, sometimes early in that process, sometimes later in that process, but somewhere in the middle, the interest rates roll back over. Why? Because they realize that they were going into recession. And people think, well, hey, interest rates are going lower. That's great. No, almost every single time. But basically, no, take it back. Every single time. At some point in the middle, interest rates went down and the stock market went down harder. In other words, when the top in interest rates during a bear market, is not the bottom in the stock market. When on a short-term basis, if rates are going down, I'm talking over intermediate-term basis, they've been going down, and they rise a little bit for like a couple of months, and then they roll back over. That's bullish, because they've been going down anyway. Well, these things have been trending up. People, don't forget that the interest rates have been trending up for a while now, and so when they roll back over, it's during a bear market. If the interest rates rolling over are not just showing a blurb on the radar screen, but showing that no, we're going to see a significant decrease in growth and therefore in earnings, the interest rates go down, and the stock market keeps going down, and it goes down usually, almost always, quite substantially. So don't get excited. These people talk about peak inflation. That's the top. That's not. There's a difference between peak inflation and peak interest rates. Okay, peak interest rates during a bear market, especially when an onset of a recession, that is negative. That means that, then that's when people are going to stop focusing on what's happening now. I've been saying it for several weeks now. The rest of Wall Street is finally coming around to this, is saying that yes, the lower interest, people are going to stop focusing on when an inflation and focus more on the economy. That's why those numbers going down is negative for the market. So we need to be very, very careful with that in the future, and as we go in the coming weeks. Can the market rally into the end of the year? Certainly can. It might. I don't think it's going to. That's another thing. People talk about seasonality. The seasonality, they're comparing apples. They're not comparing apples to apples. It's seasonality, the end of the year, even in election years, the market doesn't always go up. It usually goes up, but it basically never goes up at the end of the year when you're in a bear market, whether it be 2000. I think in 19. Just look at the last midterm election. Everybody said, "Well, midterm elections is always bullish." I'm going, well, the last midterm election, the market went down 16% from election day to Christmas Eve. What are you talking about? I mean, one guy was sitting there claiming every single 100% perfect every midterm election since World War II, the markets rallied at the end of the year. I'm like, just look at the most recent one. That's just flat out wrong. Flat out wrong. Okay. But you also go back, if you compare the end of the year, not just the midterm election years, all years, the market does tend to rally into the end of the year, but not during bear markets. We saw it in 2018. We saw it in 2020. Remember, that was that bear market. I mean, it lasted 2 months. And by the time we got to the fall, it wasn't in place anymore. But 2007, 2008, that bear market went down in the second half of the fourth quarter. Same thing happened in 2002 and 2001. There was 1 year that year where the market actually went flat, that bear market. The bear market of 1993, 1973, 1982, every single time. That seasonality BS that these people on Wall Street keep trying to tell you doesn't work. There's been 1 year where it worked. I think it was 2001, 1 year where market didn't go down. It did go up slightly. So I'm not saying definitely the market has to go down. I'm just saying is that you have to compare apples to apples, and you got to be careful of these permeables on Wall Street, so many of whom are paid to be bullish. And in some cases, they just, I'm not saying they're lying. They're just misinterpreting the facts. I mean, how can you, it was just 4 years ago, 2018, the market got hit. Anyway, so that's really what we're trying to accomplish here in the chat room. Now, Rodrigo, you still there, bud? I'm going to go, I don't want to talk about another thing here on the, on this whole thing with the chat room. I think is very important. And maybe the most important thing. I should have led with this early on.
Yeah. Can you hear me?
Yeah. Sorry about that.
Sorry, my mic was a little bit. There's a couple of questions here we're getting about their live room here. Let me just go over them really quick, and then we can get into a little bit of a market discussion here, folks. So thanks a lot for sending these questions, folks. So basically, yes, we do have an access here for Matt Maley's live room where he's posting trade alerts, entries, exits. There's also several meetings throughout the week that you will have access to. This is something that we're only doing here for today. So yes, the price is, so it's $19.97 for the year. It will renew at the same price. Next question here, does Matt go over education? Yes, as you can see, everything here is about education. Does Matt post entries and exits? Yes, he will literally give you the exact contract price, expiration. He'll tell you when he buys it. He'll tell you when he sells it. All you have to do is literally follow Matt's trades. Next question, are the sessions recorded? Yes, all the sessions are recorded that you will have access to with Matt. So you will have access to that as a member. And let's see, next question. Is this good for beginners? I would definitely say so. This is perfect for beginners. We're not doing spreads or butterflies or condors. These are calls and puts. These are very simple trades. Let's see, next question. Yes, so we are going to be rolling out push notifications within a couple months. So you guys will have access to that. And the link to join is posted in the chat. If you have questions, I'll put the contact there. make sure to email everybody that signs up while we're live. We'll get additional trade alerts and strategies from Matt. So, Matt, let's talk a little bit here about the whole crypto situation. As you know, you've been covering this quite extensively. Where do you feel crypto in general, right, is going to go, and could this spill over to the general market?
Well, the one thing is that on the crypto, I just see what it's trading here today. Boy, it's just funny how it's just that this news has been really bad. Yeah, look at it. Now, this fall right here, that happened before the announcement that FXI was going to go under or declare bankruptcy. Now, okay, let me just get rid of some of these lines so you can see those moving averages in there. There we go. So you can just see a little bit better. But see this move, like obviously somebody got the inside scoop and that FXI was about to have this problem. So they sold. But since the news came out, it's been really tied up in a sideways range, which is good because there's still a lot of people who are leveraged in this marketplace. Now, thankfully, it's not as big as even though there's a lot of money in it, not anywhere near as big that would suddenly have the impact that the failure of Bear Stearns did, or certainly not the Lehman Brothers back in the day. 12 years ago, 13 years ago. It's not a multi. It's not going to be a Lehman moment, I guess is my point. But this has got I think it's got a long way to go. I think we're looking at something down near 10,000 or probably lower before it bottoms out. It's just, again, one of the reasons. Again, I do believe that it's going to be a lot like, and I've said this all the way through the year, that when this is much like it was with the internet stocks. The best ones, like the Amazons of the world, did extremely well, but they still went down 90%. Was it 92%? Amazon went down 92%, even though the revenues were growing. And from 2000 to 2003, their stock went down 90% because it got so far ahead of it because all that liquidity got pushed to the upside. Now, I don't know. I'm not saying that we're going to see a 90% decline in the cryptocurrency. This is Bitcoin right here. But see what happened here? I mean, look at that. That is all because of that Fed liquidity the post-pandemic. Okay, so it just went way, way, way too high. All these people had all this liquidity. They had nowhere to put it because the emergency was over. They didn't need to do it to support the economy anymore. So they put it into risk assets, and they went into the hottest ones, whether it be the cryptocurrencies or the meme stocks, AMC movie theaters going through the roof, GameStop. I mean, it's crazy. And so I guess my point is, as this liquidity becomes less and less plentiful, and through the QT program, with the not just raising interest rates, but shrinking their balance sheet, that's going to cause further problems for I think the cryptos. But again, I like them longer term. I don't think that but you got to be the right ones. I mean, Ethereum probably the best one right now, but you need to be very, very careful. The other thing to note though is that. Yeah, it's just again, you have to understand. I mean, I just think it's vitally important to realize that just because, even though I'm saying it was all liquidity, that it wasn't all liquidity. It was just a big part of liquidity. The blockchain technology is going to be with us for a long time, but you just have to be very, very careful. And the other thing to note, though, is that I think maybe the most important thing is look what's happening here. Everybody's saying, "Is this a Lehman moment?" It's not a Lehman moment, but will we get a Lehman moment? It may not be anywhere near as bad as Lehman, but it'll be a bad one. And my point is, look what's happened here. First, just a few weeks ago, we saw Credit Suisse. Now the stock's making a new low. I mean, so they're worried about them going out of business. And that was the first kind of. Then all of a sudden, FXI does declare bankruptcy. All these, you see it again. The old saying goes, when the tide goes out, we find out it's been swimming naked. And that's what's happened here. And then now we have certain companies like Carvana. Now, they haven't done anything illegal. They haven't been, this FXI, very, very questionable with taking company funds. That's a big, big no-no. And again, I don't know the details, so I can't make it. From what I hear, it sounds like he was taking customer funds, and that's just, he's in big trouble for that. Okay. But Carvana doesn't sound like it was doing anything like that, but it's just their business isn't as good as people thought. Just like some of the businesses in their business model, or some of the businesses in the internet. Some of them just weren't going to work as well as Amazon's did, or several others did. And so that's going on in business. But you see, it takes time as this liquidity gets pulled away from the marketplace. People still hold on. Now they pull the liquidity, and everybody doesn't go out of business automatically. They start realizing, oh my gosh, all that money we were getting, we were losing business, but you know something, all these private equity firms were still throwing money at us, so we were fine. Well, they're not throwing money at them anymore because they don't have money coming in like they used to. Right? And those private, and believe me, there's going to be a lot of private equity firms that merge or go out of business because there's just not going to be as much liquidity. Don't get me wrong, a lot of really good tech companies are still going to be funded, and the best private equity firms are going to still do very well. But it's not going to be a great it's just not going to be as much money out there. And look what all this money that went around in Facebook, Meta. I mean, they blew $10 billion. How are they able to do that? Because they had all this money coming in. Well, all the money is not going to be coming in anymore. I mean, they're not going to make those kind of profits to just piss away $10 billion on Meta. Okay, that's what they've learned this year. This may present a great opportunity to buy the stock, and it will at some point this year because they're still a good business, I think. But the point is, it's more than just will crypto have an absolute direct impact on the marketplace. I'm sorry, a direct impact on causing more forced selling or causing banks to win or things like that. I'm less worried about that, as other than this is one of the first of the early signs of many things are going to happen just like it over the next 6 months. And it's exactly what happened during the great financial crisis, when it wasn't, everybody talks about the Lehman moment. The Lehman moment came towards the end. Now, of course, we did see one last big bad dive after Lehman. But before that, we had Bear Stearns. Bear Stearns went out of business in March of 2008. But 6 months before that, in the summer of 2007, two of their hedge funds went belly up. Their two big main hedge funds. That's, and then we just won. There was one after another, just these smaller things, and it all built to the point when Bear Stearns went under. Okay, they let them go under, and then later on, there's other problems until then the Lehman moment came up, and then the real reason, of course, that Lehman was allowed to go under is because they couldn't afford for AIG to go out, who they saved 2 days later, because if they went under, Goldman Sachs was going to go under because they had too much exposure there. That is the truth, I guarantee it. Anyway, so I guess the long-winded answer to the question where what does this mean? Directly impacted, I'm less worried about it, but I'm just thinking, it's like where there's smoke, there's fire. So we saw it with First Boston. Now we're seeing it with this. We're seeing it with companies like Carvana, which are suddenly reporting tough earnings. And we're going to have more blowups like this, where companies go out of business and they're going to owe money and leverage, whatever. This is the unwinding of leverage after a bubble has been formed. Takes time, and there's a lot of casualties along the way. The one thing though is just to talk about this, and when we talk about the whole overall thing, is that I mentioned how these hedge funds and how they trade. I mean, that's what people are active traders. If you're trying to trade on your own at home, that's very hard. It's very hard. But thing about the best traders in the business. That some of these hedge funds are big, mutual funds or small. They may be small hedge funds. They want to stay small. They're really, really good. They're just not as well known, but they're very, very good. But the whole point is that they are talking to traders all day long. If you work at a big hedge fund, you might have 10 traders you're in the same trading room with, and you're talking to them all day long. You're doing the same thing with your brokers. Your brokers are talking to you all day long. Hey, did you see this? Hey, what do you think about this idea? Or, hey, I've heard this about this. Hey, Advanced Micro Devices is getting hit. The rest of the semiconductor stocks, the chip companies are going to get hurt off that. They're getting this information. They're getting ideas. They're making sure people notice things. Hey, did you notice that the high yield market is suddenly rallying here? This might be really bullish for the stock market. They're hearing this stuff all day long. They're hearing it from each other. And again, you're in a mutual fund. Some of these good-sized mutual funds will have 5, 6, 7 traders. Some will have 20 traders, and they're all giving each other information all day long. How in the world can you compete with those people if you're not in a chat room like ours and getting these types of feedback and updates? I mean, we can again, the financial news services are fine, but they are good. I mean, they're very good. The only problem is that sometimes they have to interview people that are again paid to be bullish and not necessarily um, giving all the best advice. But the point is, if the best and brightest and you know, they still lose money. They still lose money. These hedge fund traders talking to the best brokerage firms and having their and this team of traders that they're working with all day long. How are you going to sit there and do it all by yourself? It's very, very difficult. So that's what really works. Where we're talking things. I mean, I'll tell you what happened. Some real nice money we made early this year, the first quarter. We have people in the chat room are from Eastern Europe, and they were talking about what they were seeing and what they knew about, not just what they're seeing overall, but what they know about the situation going into it and their lives. They're like, you know, Putin is not, you know, this is what Putin's going to do. And gosh, it was so spot on. It really enabled us to make some really good money making negative bets in the options market when the market was really starting to roll over in a major way. And you know, so it's and other people talking about you know, they're in the real estate business, another guy in the restaurant business. There's a guy who's a great guy. He's a UPS driver. He works for UPS, and he's telling us what he's seeing in terms of the flows there. That's going to be, believe me, that's going to be very helpful this coming season, next few weeks as we move into the summer, into the holiday season. I mean, right now the consumer is going to be really, really important. What they do going forward. I mean, you know, they might go ahead. This might be the last hurrah, and they might really be spending. I'm hearing all sorts of different things. I mean, you have, you know, one source saying, well, and rightfully so, saying, hey, Friday, Black Friday, they had the best online stores ever. But online stores sale, Black Friday is known for the brick and people going to stores. And that kind of traffic, supposedly is down. So the question is, we all already know, hey, the consumer's been really strong. How much longer can they stay strong? I've been saying for months, it's like it's going to be very difficult for them to stay strong because you see what's going on. The savings rate has fallen through the floor. It's back down to 2008 levels. Okay. Credit card debt and consumer debt overall are making new all-time highs. So people are only keeping the spending going by borrowing. They can only do that for so long. Maybe they'll keep that borrowing for one last hurrah. As we go into next year, that's going to be much tougher. I'm worried that it's not even going to happen. We're not even going to get that far. That this holiday season is going to be tough. If that's the case, the consumer does start to pull in the horns a little bit more. The reason why I think this is that people are starting to get their heating bills, and you know, before it was the gas, then they get their heating bills like, oh my goodness, I'm paying more than twice what I paid last year. Even though oil prices have come down, they're still way higher than they were last year. This is a problem, and it gives people, you know, 64% of Americans live paycheck to paycheck. All right, if they've got to spend more of that paycheck to feed their families because of the war in Ukraine, has food prices up, heat their homes and drive their cars, that gives them less for everything else, and that's why the consumer is going to come down. But it may, again, I fully acknowledge it may not happen until after the holiday. But right now, what I'm hearing is that Black Friday didn't go that well. But we'll know early next week. We'll know very early next week. Again, we have Cyber Monday. See how the things are going, and we'll get reports. You know, Monday, Tuesday, Wednesday. And if this is a disappointing consumer, you know, again, as I've said before, people are focused much less on what's going on with inflation and much more on what's going on with the economy and earnings. And given that the stock market is already too expensive compared to the underlying fundamentals, if those fundamentals are going to start turning down, it's going to be tough on the market. So next week's going to be a really, really important week. But it's going to be. Go ahead, Rodrigo. I'm sorry.
Yeah, no, I mean, there's a lot of volatility right now in the markets, and I mean that's basically your bread and butter, right? And it looks like we're going to get more volatility. It just doesn't seem like I mean, if everything's fine and dandy, I guess, you know, there's not much volatility, I guess, right? So
yeah. I mean, that's and you know, we had very little volatility on Wednesday and Friday, which was a half day of trading, but very little volatility that day. But that's because it was around the holiday. Believe me, we're getting to next week, and things are going to be. I'll just, you know, let me just show you something here. But look at all sorts of different things that we have here. Look at the dollar. I'm going to pull up the dollar. This is the dollar index, the DXY dollar index. Okay. Now, whoopsie. Why isn't it coming up? Strange. Hold on a second. Let me try it again. Okay. DXY. Oh, probably because I didn't do this. XY. Sorry about that. This will only take a second. Currency. Okay. XY. Huh. I don't know what's wrong with my. Okay, everything's gotten backed up. Okay. Well, let's go. I'm going to look at. Sorry, one more time. Okay, good. Now I'm going to do is just go. Let me see. Okay, sorry that took so long, but I just got a little bit stuff. But see how here, this is the DXY dollar index, and if the dollar, if the dollar can go lower here, that should be theoretically bullish for the stock market. It's not always that's not always the case. It's not been the greatest indicator in the world, but it has been this year. When the dollar's gone up, that's been bad for the stock market. As the dollar's gone down, which it's been doing lately, has been good for the stock market. But look here. Okay, see here now, see this purple line? That's the 200-day moving average. You can also look at it though. You can see where it's also the lows from August. Okay. See, so if we break below the 200-day moving average and below makes another lower low, that's going to be real negative for the dollar and should be helpful for the stock market. So we're going to be watching this very closely, but also look, this RSI chart getting oversold here. So we're a little worried that it's going to be getting oversold and it could bounce off this key support level. If it does that, just like it did in August, boy, we know what happened when the stock market, what happened in, from mid-August to the end of September, where the stock market sold off in a big way. This is at a key inflection point. Some point in the next several days, this is going to say maybe the next week or so, we're going to get it. We're going to find out whether it's going to break down more or bounce back. We have crude oil. Crude oil here, testing. Okay, there we go. Let me get rid of some of these. Again, I'm sorry I have so many lines on here, but I look for people I've been doing it too long, it gets a little busy. So I like to get rid of some of these lines so it just doesn't look quite as complicated. Whoops. 2020. There we go. Okay. Okay, we want to get rid of that real quick. I remember when it went negative. But here we are. See how it's getting down to got up near its 200-day moving average. You can see that's really important resistance. But it's right now, it's right at this level where it's testing its September lows. What's going to happen to this thing next week? What's it going to do? Let me blow it up a little bit so you can see a little bit better. Okay. Here we are. Is this going to break down and make a key lower low? Okay, obviously it's been making higher lows and lower highs and lower lows for several months. And okay, finally made a slightly higher high, but couldn't, and made a higher low. That looked good. It's like, geez, can we make a higher high now? Again, when you switch from making lower highs and lower lows and switch and start making higher highs and higher lows and higher highs, that's a key change in trend. Well, guess what? They didn't get it. It stopped right at that level. It's a mini double top. Now it's trying to bounce. So what happens next? This is such an important level. It's getting oversold. It's not wildly oversold, but you can see it's getting oversold. Do we make a double bottom here? Double bottoms can be very, very bullish and then explode higher. Or do we break below that level and fall down? I think we hold. We might dip a little bit below it again. You can get a little, you can see what happened here. It got below its 200-day moving average, but only slightly so, and then rallied back. That's what we're looking at here. Okay, this is a situation where if it drips down a little bit below it, I just think that with what's going on in Ukraine, I don't think that's going to get as better as many people think. And I also think that the OPEC is not going to be very helpful on this, especially now that the election's over. The Biden administration, the SPR, that's not going to be as important. I think this will bounce, but it's going to be something we're going to be watching very, very closely next week. So we're going to be watching the dollar. We're going to be watching oil. What does this mean? Do we go in and buy index puts or calls? That's what's going to decide. Do we go in and buy the XLE, which is, we love the energy stocks. And I've been talking about that for a long time. Okay. People were asking me last week, geez, these energy stocks are down. Maybe I should buy them. I'm like, no, let's hold off. Let's hold off. See how oil's been going down, but the energy stocks have been holding up. That is a positive divergence, but I don't, again, here's another situation where we might get a breakout move to a higher high. Let's see here. Oops. 2, 0, 21. Okay. Okay, so we're waiting to see, can this thing make a higher high? So I was worried because oil's been down, but see here, see how we made a slight higher high, but we haven't really been able to break out yet in an important way. Whenever you get a break above a resistance level or below a support level, it has to be a meaningful break. This wasn't meaningful. So what we're now, though, see how it was overbought? It worked off some of that overbought condition. Whatever oil does next, if oil bounces nicely and this thing breaks out, man, we're going to be buying energy stocks in a big way.
Right.
If it fails, we're going to hold off. So you can see that we got a lot of stuff coming in this upcoming week to 10 days that are going to give us a lot of opportunities to trade. Whereas late last week, it was really quiet. We didn't make many trades because we're not going to force it. We're not going to just trade to trade sake. We're going to trade to make money. And a lot of opportunities, I think, in the next couple of weeks. It could be as early as tomorrow.
Right. So yeah, man, we've been definitely covering a lot of topics here, a lot of trade ideas, a whole bunch of market discussions. Do you think should we go and just get some tickers from the chat, Matt?
Yeah, that'd be great. It'd be great. Just talk about any. It doesn't have to be an individual stock. If there's a an ETF or something, if you're worried about the semiconductor stocks, or if you really like the biotech stocks or the bank stocks, whatever, we can talk about ETFs as well. But yeah, just throwing some tickers there. And while you're giving some tickets to Rodrigo, I'll just talk about a stock that, of course, everybody always cares about, and that's Tesla. And just let's look at the chart here. Now, what we had, and when we had a real good call on this one recently, let me go here. But now it's like, okay, but now we have to figure out what we're going to do next. But just to give you an idea of what we talked about in the chat room, people were saying, what's going to happen with the stock? And down here, okay, what we had, and let me get rid of some of this stuff. I'm going to get rid of all the moving averages. We don't need them here. But what we had here was called a descending triangle pattern. Okay, and we broke it. And so we were talking about this about 2 weeks ago. And I was saying, see this thing here? It was white, bang. So it was what they call a descending triangle pattern. And I said, if we break below this 200 level, just above 200, this stock's going down to 170. Well, sure enough, it worked out beautifully. And we doubled down when the stock bounced, and people were buying puts here. Now, but then the stock got oversold. It's trying to, so it's okay. What have you done for me lately, Matt? Great. Thank you. Made a great call there. Well, what's your next call? Well, what I'm worried about, because I'm worried about the markets. I'm worried about what's going on in China. I don't know if you've heard about what's going on there this weekend. There's real protests and riots are really ramping up, and people are worried that they're going to, China's market will get hit next week. We'll see. We'll know tomorrow. And that may spill over into the rest of the world, because a lot of people are banking on a reopening of China to spur economic growth around the world. And China is so important to Tesla. And so what I'm thinking is that if we, I've been thinking, geez, maybe it gets right back up to that old resistance level. I'm sorry, that old support level. That's one of the rules. Again, we learn about old resistance becomes new support, and vice versa. In this case, it was old support, it becomes new resistance. If this news out of China is there, it's not even going to get there. So I think it could go a little bit lower here, but I like the stock. I mean, there's going to be a good buying opportunity in this thing at some point soon. So we made a real nice call. It worked out really well when we called for for it to fall. When it broke 200, we said it's going to 170. That worked out really well. I just want to see what happened to my daily. Oh, okay, good. Yes, good. There it is. Sorry. But this is a weekly chart. See how it's starting to get oversold? It's not quite there, but it's getting pretty darn oversold. And if you go back several years, see, it never really got, only in 2019 did it get really wildly oversold. So it's getting to that level. So we'll see what happens in China overnight, tonight and tomorrow, and then we're going to figure out how to play it from there. If it's okay, we'll look for the bounce to $200, and then if and when it gets there, what we'll do is, again, It's risk management. That's one of the big things in our chat room, risk management. We'll look to buy some puts thinking that it will fail at that new resistance level, but we'll have a tight stop because if it breaks back above 200, it's going to go. So again, we'll have to stay very, very nimble. Oh, and just another thing just to mention a second. So where do we put these things? We have this chat room and it's scrolling all day long. But whenever I do a trade, we have a separate page and it tells you, hey, we bought this, we've bought this option or done this trade today, or we've closed this trade today. So if you're off doing something, some people are in the chat room all day long, other people are in, then have to go out for an hour or longer or a couple hours, and they go back in and say, well, I'm not going to scroll up and down 2 hours of comments, just try to figure out where Matt put a trade in. We have a separate page. Just click on that and say Matt's important messages. Sometimes there are non-trades in those important messages because obviously not every important message is just a trade, but you can find, you don't have to scroll down. It'll be right there. Oh, geez. And then you come in right into the chat room. Hey, Matt, you did this trade an hour and a half ago. Do you still like it? Can I still take advantage of it? And, usually I say, yeah, it still works. Or every once in a while, I was like, actually, it's already moved in a big way. We've made a lot of money, but most of the move has already taken place. Well, you miss it. Don't worry. They'll be playing more.
Right.
But you can see it right there. You don't have to go searching for it.
Yeah, no, absolutely, man. China is, there's always a lot going on there. Last time there were protests there, the COVID thing happened, so
right.
Very coincidentally,
Yeah.
but so there's definitely a lot of action in the chat room. And look, I mean, we all appreciate the fact that you're a straight shooter, Matt. You don't sprinkle anything. There's no spin. It's really more like, this is what we need to do. It doesn't matter if the market goes up or down. We're going to make money either ways in the chat room. So let's get a quick ticker here. Let's see what we got. All right. So trade something there is a Etsy. So ETSY.
Oops. Now you'll see I always type in RSI. I just think it's a good base stock, but it's just out of habit. RSI is it's very important. So it's one of the reasons I use it. But there are obviously many other things that we look at besides the relative strength index. But let me just pull these. Now, two things here we're looking at. Okay, number one, let me get rid of this. Okay, it's not overbought. See, it got a little overbought. It's worked that over off, so we don't have to worry about that. So I'm going to take that off the screen now. What we have here, though, is look at this thing. We call this you can call it a megaphone pattern, or even just it's kind of a sideways range. But I'm going to take away these moving averages, and I'll bring them back in just a second. Okay, but megaphone patterns. It's a key issue here. We're going to be watching this one very, very closely. Sorry, let me get rid of this and pull up this. And I don't know how I want to do it, but. Let's see here. Oh, shoot. I picked up the wrong thing. Hold on. Don't worry, I'll get that out of the way. There we go. And let me get rid of that. There we go. And see this? They call it a megaphone pattern. Now, this tends to be a negative thing, okay? It's maybe, or a rounding top. This thing gets up to here, and then it looks like it would probably want to have to come down here, but I don't see it as being overbought. And so what I'm seeing is if it can break above that level, okay, that's going to be quite bullish for the stock. So let's just pull it up here so I can get the correct level. Bang, bang. That high is there it is. I'm sorry. 127, basically 127.25, 127. You break above that in any kind of meaningful way, that's going to be bullish. But let's look at another chart. I mean, the chart for Etsy. Hold on a second. Okay, ETSY. Okay, so we got two things going on here. See, this is what's called a MACD chart. Again, some of the educational things we talk about. This is when It's the 12-day moving average is actually 12-day exponential moving average. Crosses above or below the 26-day. It looks like it might make a negative cross, but see how many crosses it's made in both directions? All these mini crosses, it hasn't meant anything. So for this one, it's like, okay, MACD doesn't help us for that, for this particular one. It's very, very helpful in a lot of stocks, but not in this one. But I'm going to go back to this other chart I was telling you about. We want to look at those moving averages again. I'm going to go back a little bit further. Let's go back. 2015. Let's get rid of the RSI again. We don't care much about that. We're going to get rid of a couple things here. Whoops. There we go. Okay. We're going to get rid of the 100-day moving average and the RSI. Bang. Okay. Now look at this. Look at this thing. See here. What we have here is a golden cross, the 50-day moving average crossing above the 200-day moving 200. Look how bullish that was for the stock. Okay, same thing happened here. It actually had a minor death cross, but then another bullish cross right here. Boom! Look what happened in the stock. Then we had a death cross, a negative thing. But look at it here. I'll blow up again. But again, we had a bullish cross in here. It's harder to see because it was so thing. But again, here's a situation where death crosses and golden cross, again, for those people who don't know, it's a golden cross is when a 50-day moving average moves above the 200-day moving average. Look how close this is to a golden cross. Now, I got to admit, technically, you want to see both. Okay, why is that not? Okay, good. Okay, now we can see it better. Okay, this is good. Okay, it is, you want to see both moving averages rising when you see a golden cross. Okay, and look, see, you can really see it there. It's hard to see on this screen, but it is turning back up. It is looking very, very close to a situation that, in fact, it might actually be turning up. Hold on, let me just go here. The 200-day 106, 22, 14. Okay, it's still going down, but very slightly. If this thing crosses anytime in the next week, on the positive side, next 2 weeks, the 200-day should be starting to move up. That will be a bullish cross, a bullish golden cross. At the same time, it's breaking above this high, right? Above that pattern I showed earlier. So again, I kind of rambled around about that. So key, if it rolls over right here, we got problems. And again, it's not a major thing. But boy, if this thing gets above 127-ish, that's going to give it a golden cross, take it to a higher high. That's going to be very bullish for the stock.
Right. Yeah, so I mean, this has been a great session here, Matt. Do you have any closing remarks here on your end on why the folks should join the chat room, and what we'll be looking forward to next week?
Yeah, so just again, I guess the key thing is don't trade alone. It's just very, very difficult to do. It's been a great year for us. We've made portfolios up several 100% in a year. And again, that's it's the trading aspect of our portfolio. We have the bigger long-term asset, but I went to almost 100% cash on that. So it's been a very good year. And I just think that if you're trading alone, it just makes it very, very difficult. If you're on one of those chat rooms that has 30,000 people in it, you don't know who they are, what they're trying to do, or they're doing the pump and dump. We're here, we're trying to help each other. And it's just a great way. When the volatility is here, you can be somebody where the volatility controls you, or you can be somebody who can take the bull by the horns and take advantage of it, because that's what can happen in these kinds of situation. In this coming week, we got all sorts of great things taking place. I mean, interesting things taking place. Gold is near a breakout level. I told you about the dollar. Looks like it might want to do something. We didn't even talk about the yield on the 10-year note is at a key inflection point. We have Apple Computer sitting in an incredibly important part on the charts, but on the fundamental level, what's going on with the, their Foxconn plant? Are they going to be able to get the product to sell? It's a great company. It doesn't mean it's a great stock. If things are going to slow down in China, that's going to hurt their sales. And obviously, there's nothing more important than Apple Computer. So, and then we have, and again, I would say key resistance levels. The S&P is touching a key Fibonacci resistance level, and so is the NDX, the NASDAQ 100. Do they break above those levels and really break out and give us a year-end rally? a further year in rally, or do they bump up? Are those preside the real good resistance and they roll back over? This next week, we are. I mean, we want to be very, very nimble. It could go either direction, but a lot of things are going to be happening all at once. A lot of triggers going to trigger off at once, so it'll happen all at once. That's going to cause, I think, some more big moves in the market, one direction or the other. I think it'll probably be to the downside, but I'm going to be smart enough and nimble enough to let the market tell me what it's going to do, and then we'll react to it and take advantage of it. But like I said, this is not a time. The buy and hold strategy, again, it's fine. There's a few stocks out there like Google or Alphabet that I do like on that type of situation. For most of the names, we want to trade them actively. And like I said, it's a great time to do it. I think it's going to continue to do it. Good luck to everybody. For those who are interested, I hope you'll take a look at it. And good luck with everything, and have a great holiday season. I hope everybody had a great Thanksgiving out there, and have a great holiday season and New Year.
Yeah, man. I appreciate you, Matt. Great session. Again, congratulations, man. 40 years. It's been great, man. And, we're looking forward to enjoying the chat room there. So all the folks, if you have questions, I put the contact there for you to reach out. Matt, thanks a lot, man. And I'll see you in the chat room tomorrow, right?
Sounds good. We'll see you there. And again, happy holidays to everybody, and good luck. It's going to be an unbelievable year in the next year. And I think, I think what we're doing here is going to help a lot of people. I hope you'll join us. Thanks a lot, and take care.
All right, Matt. Thanks a lot, man. Folks, right, so that's Matt Maley, Chief Market Strategist there at Miller Tabak, and lead trader at the Stock Picks Inner Circle chat room. Even though we're trading options, folks, you can ask Matt about stocks, anything like that. So I hope you guys have a great Sunday. Have a good day, stay safe, and make sure to join the chat room. You don't want to miss out. So big shout out, Edwin, Latoya, Jamila. I'll see you guys in the chat room. Have a great day, folks.